Hey, what is going on, crypto people? Listen, here's the part that crypto Twitter keeps missing. This isn't just regulation. This is banks protecting their profit model. One side is literally saying, don't let stable coins pay people interest because it would force banks to compete. And at the same time, the biggest banks are printing money over a massive spread, paying depositors pennies while collecting record interest income. Tonight, I'm going to show you the receipts, explain the playbook, and why this matters to every single person holding dollars, stable coins, or crypto. We're going to get into it today. And again, I got some receipts. I got a couple of articles to share with you guys because I think it's important to understand what's really going on. A lot of people in crypto are just quite frankly naive about what is going on. Just completely naive. I did a post on X sharing with people the process for a bill, how it gets introduced, why it gets introduced, what it's really doing. Like a lot of people, we've been hoodwinked into thinking that it's the Congress people because they're all dressed up in suits and garb, and we think because they're presenting that they're the authors of these bills, and they are not. They are not. You're sure you can get a staffer doing a little, maybe they come up with a headline, but the vast majority of these things are done by people who have stake in what they could represent, stakeholders. Got to get it. And it's amazing to me how quickly people forget. They must have thought the whole incident with Elizabeth Warren when she got caught feeding not only Gary Gensler the lines or the answers, but the entire script. I guess crypto forgot about that. I just thought, oh, you know what? That's just Elizabeth Warren. That was just her. Like they're missing the big picture of what really goes on with these bills. Missing the big picture. So we're going to get into that. We're going to talk a little bit about that. Appreciate you guys hitting that like button on the way in. That'd be super dope if you could do that. This is hugely important because, again, we can no longer afford to be naive about what's going on here. This is too important. It's too important. And people are running around um, in naivete, not taking a second to understand what the real big picture is here. And I'm glad I came across this thing on X, and perhaps I'll share it. It was a little 3-4 minute video, and I posted it on X, but it was essentially one guy whistleblowing, essentially about how he hoodwinked the American people by request, indirect or direct, by former administrations to come up with something just to hoodwink and bamboozle the American people. It wasn't by Congress. It wasn't, it was draft something, let's give it to the House. The House, okay, cool. Then they'll put it to the Senate. And the dude used a phrase that is just for me alarming. I can't wait to share it with you guys. That is the real deal. He used this phrase about the American people. You're not going to like it. But that is the real deal. That's the real deal. That is the real deal. So, and that's unfortunate that we are thought in that manner. The American people are thought by that manner by members of politics. Now, whoever you want to say are members of politics, that's how we're thought of. So, if you think that is a local state representative or council person, all the way up to the commander in chief, I'm saying politics. That's how they think about the American people. It is alarming. It is alarming. So what's going on? Joe Buddy says, I'm not here for 4% stablecoin yield. Then what are you here for, bro? What are you here for? If you're not here for that, what are you here for? Because they're trying to take away your 20Xs. They're trying to take away your 15Xs and your 10Xs. Did you know that? Are you aware of that? Well, I'm going to share that with you so you're about to understand. Because ultimately, if you hold crypto, this ain't for you. This is not for you. Like if you hold crypto, that current form or that bill is not for crypto holders. So what are you here for? What are you here for, my friend? What are you here for? So we're going to get into it. We're going to cover some things because this is important. This is big time stuff. I got an article for former Congressman, Senator, I believe it was the Senator Pat Toomey. And I remember reading this 2 or 3 times. It was in the Financial Times. And I remember thinking to myself, why is this dude who's in retirement, I don't know what his net worth ended up being. I don't know what his network ended up being. Is that right? Yeah. Once he retired, I do know that they get 6 figures and multiple 6 figures in retirement every single year. But why would he take the time to write that article? Why would he take the time? No. You being cocky. I'm not being cocky, bro. I'm asking you. You said you're not here for 4% stablecoin yield. I'm asking you then, what are you here for? Like, what are you here for? I'm here, and I'll answer for myself. I'm here to create generational wealth for me and my family. Why are you here? What are you here for if you're not here for 4% stablecoin yield? Like, what are you here for? Why are you here? What do you hope to get from this new asset class, this new financial system? What are you here for? So I was thinking, like, why would he do that? Why would Senator Toomey come out of retirement? I mean, not come out of retirement, but he's in retirement. Why take the time to post on X, to post on X, and then, well, he posted on X promoting what he wrote in the Financial Times. Why? I kept asking myself, like, why? Right? So for me, if I'm here for generational wealth, that includes stablecoin yield. That includes that, right? Because you got to have your dollars making dollars. But this is bigger than stablecoin yields, and a lot of people don't understand it. They don't know why. They don't understand it. It's bigger than stablecoins. And I'm going to share it, but I'm going to share a couple articles. Now, I've been posting on X a bunch about this and what this ultimately is. People don't understand carve-outs and definitions and terms like inducements, ancillary assets. People are not reading the text. They're not reading the text. They don't understand the process. They don't know who actually put this version of the Senate's Clarity Act, who put it front and center, who dropped in the last hour 270 pages of new stuff in the last hour. Most people were asleep. They don't know about that. They don't know that's exactly what happened. No one's speaking on that but the people from Coinbase. Why isn't Brad speaking on that from Ripple? 270 pages in the last hour. And the stroke of midnight. You don't think that was intentional? That's where a bunch of the gotchas were. Like One of the gotchas, for example, is essentially saying, oh, no, 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 no. Most of this stuff is not commodities. Most of this stuff is securities. And we want the SEC to oversee it. Did you know that was in there? Did you know? So this is the deal. I'm going to share a couple of things and I hope it makes you think, right? Also, by the way, great interview today with Paul Barron, the Paul Barron Network, interviewed the guy from I Trust Capital. Eye-opening interview. You should check that out. Really good job by Paul. uh, really good perspective from the I Trust Capital guy, who's in a very unique position. It's a very unique position where he is, I think, as a business owner of a successful company offering a very, very successful project. Yeah. One I turned down in its early days, first 60, 90 days. I didn't like the idea of a custodian because I wanted to self-custody. It's one of the biggest reasons. I wanted to self-custody. But that product and that company has, let me tell you something. Ooh, they are doing big things and they're doing it right. I've heard nothing but really, really good things. He was really smart in that interview too. He shared a lot of good stuff. But they're doing a lot of things right. And it's one of those things, I think, for people who they want a better peace of mind. The idea of self-custodial is just not their thing. They don't have that stomach for it, right? And so that was a really, 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 really good interview, by the way. Really, really good. So again, I ask you, why do you think former congressman, I don't know how many decades he spent in Congress, would take the time to get on X to promote something that he wrote in the Financial Times about what's really going on and what the banking lobby is really doing with this market structure bill, which is the Senate's version of the Clarity Act. You ever think about, I mean, dude's cool, right? However, however millions he's made, I don't know. I don't know what the number is. How many millions he made? And he's getting six-figure to multiple six-figure in retirement. You ever think about why take the time? You ever think about that? Why take the time to write an article in the Financial Times? That's what I'm saying to myself. Why bother to do that? You ever think about that? What's going on, King Kibo? How are you, bro? So my ultimate argument before we get into this is that if you're in the digital asset space because you want a level playing field and you are frustrated with a system that is not for you but is against you, that market structure bill in its current form is not for you. And I would argue that Brian Armstrong was right to walk away. It's right to walk away, right? And another thing about what people miss, I think, what stablecoin yields, like when moons, they come and then they go. They come and then they go. And then there's a bear market and then they come again. Every 4 or so years, when you get your wind moon and you get it, what are you going to do with it? How are you going to preserve and or compound that wealth? How are you going to do it? I know one way is stablecoins. The other way is DeFi. Well, guess what? Current market structure bill as it is presented is getting rid of both of them. Getting rid of both of them. Yeah. All right. So let me share this thing here with you guys. Was trying to get rid of both of them, I should say. Yeah, because I think this is important, right? This is a big deal. This is a competition war. Like a lot of people, this is a competition war, right? Banks versus stablecoins is really banks versus competition, like my friend just chimed in and said, right? I'm going to share a few things in this Financial Times article, then we're going to go over it together. The banks are lobbying Congress to rewrite the Genius Act, something that's already been passed and done, to block interest and rewards to stablecoin holders. You got to get right something that's already happened. They didn't win, and they're trying to rewrite it. Right? Right? And you understand something with the Genius Act that was passed, bipartisan. It requires stablecoins to be backed 1-to-1 with cash and T-bills. Those assets earn interest. Right? So in a competitive market, issuers and platforms would share yield to drive adoption. Whatever Coinbase is offering, Binance US could offer, Kraken could offer, Gemini could offer. Right? Creating competition. The banks, ultimately, if you understand, want to have their own stable coins and not give anyone rewards for having the stable coins, their stable coins. That's exactly what the guy from iTrust Capital just today said in an interview, right? They want government protection from a better product. They want government protection, the banks and the banking lobby and the ABA. They want protection from the government from a better product that places like Coinbase offer. So I hope you get that. Just a little reference. Let me share some of this article here because it's important. Oops. It's really, really important. Let me do this. Again, here it is right here. It's Pat Toomey, former congressperson. I hope I framed it and put this in context for you in the beginning. I hope it adds some food for thought. Don't believe the banks lobbying against stablecoins, is what he titled it. And he's got the fact that the Genius Act was signed into law by President Donald Trump. Right? The writer is a former U.S. Senator, a member of Paradigms Policy Council, and a member of the Coinbase Global Advisory Council. Here's the X post. Here's his post. China has fired a warning shot across America's financial bow. Beijing has decreed that from the start of this year, its banks can now pay interest on digital renminbi holdings, an attempt to make their currency more attractive to hold. With the Senate Banking Committee meeting this week to consider crypto market structure legislation, it should allow stablecoin issuers, by the way, this was before the delay in the getting to the markup phase. This article was written before that, right? With the Senate Banking Committee meeting this week to consider crypto market structure legislation, it should allow stablecoin issuers, banks and non-banks, exchanges and service providers to pay interest on stablecoins just as banks can on dollars. Right? So this is not just the Coinbases of the world. Stablecoin issuers, banks and non-banks, exchanges, and service providers to pay interest on stablecoins, not so just as banks can do on dollars. When an industry asks the government for protection from competition, consumers should be aware. At a moment when America's closest competitor is making strides in digital asset technology, some U.S. banks are pushing Congress in the opposite direction. Some U.S. banks. I wonder which U.S. banks. Do you think it's like top 5, top 10? JP Morgan's, Goldman Sachs, Bank of America. Some U.S. banks are pushing Congress in the opposite direction. Banks are lobbying to rewrite the Genius Act to block stablecoin holders being paid interest. Stablecoins are crypto tokens tied to the value of fiat currency, such as the dollar. Last summer's Genius Act requires that dollar stablecoins be backed 1-to-1, 1-for-1 with cash deposits or equivalent, such as short-term treasury bills. These assets pay issues or interest to the issuer. Absent government prohibition, competing stablecoin issuers would pass much of this interest to stablecoin owners to encourage adoption. That is exactly what the objecting banks fear. If consumers can earn interest on their stablecoins, banks fear some will move money from their accounts, especially low interest ones, which is most of them. This would force banks to more expensive funding sources and squeeze their margins. We're going to talk about their margins, and we're going to cover another article. It's going to make you sick. I know it made me sick to my stomach. These banks want Congress to protect their margins, but the federal government should not protect certain industries' profitability at the expense of others, and I would say more importantly, consumers. Competition drives innovation and efficiency. Many banks are embracing stablecoin technology. Some are issuing stablecoins themselves. It's important. Many banks are embracing stablecoin technology. That's exactly what the guy from iTrust Capital said. He said he had some banks calling him up. They want to learn more about what he's doing and how they can participate. This pushback from the lobby is about that top 10 to 15, maybe. Many banks are embracing stablecoin technology. Some are issuing stablecoins themselves. Others offer them through partnerships, while still others are experimenting with competing products such as tokenized deposits. Tokenized deposit, remember, competing products. NYSE, right? NASDAQ, tokenized deposits. BlackRock tokenizing everything. I want people to think to them for themselves, were those people for us? Or did they throw shade on this industry and the people who held the assets? I mean, I ask you, right? So small banks lacking resources to develop stablecoins in-house will soon offer white label stablecoins. The marketplace, not the government, should determine which products succeed. And this is another point that a lot of people just kind of just want to, oh, okay. But wait, it's Clarity Act. But it's the Clarity Act. We need clarity. Did you know that the current version from the Senate, based upon the framing from the Clarity Act, is not and is no longer called the Clarity Act? I didn't see any mention of Bitcoin, Ethereum, and XRP or commodities. But the arguments of a significant subset of the banking industry trying to stifle competition don't hold up to scrutiny. Such critics claim interest-bearing stablecoins will cause a systemically destabilizing drain on banking deposits. But it's already possible to earn returns on stablecoins. just not from issuers, right? We can all go somewhere, get some stables, and go to Aave, right? And other places, go to Kinetic on Flare Network, right? Earn on stables, right? It's already possible to earn returns on stablecoins. And mass migration hasn't happened. That hasn't happened. We've been able to earn on stables for a minute now. Where's the mass migration that they're claiming is going to happen? The banking lobby is claiming this. Over 5 years, stablecoin issuance grew from $5 billion in 2020 to roughly $300 billion in 2025. $5 billion in 2020 to roughly $300 billion in 2025. But that is just 2% of bank deposits, which have grown from 13.2 trillion in bank deposits to around $18.5 trillion in bank deposits over the same period. So I ask you, how is it that the banks have been losing or in the future would be losing? The number of bank deposits is going up to the tune of trillions. And when I show you how much money the banks are making per quarter, and yet they're paying you 0.01 to 0.05%, and if you're lucky, 0.1%. And you're good with that? Now they want to take away your ability to earn in stablecoins on Aave or Kinetic or Coinbase. It's a big difference between 3, 4, 5% on Coinbase and 0.05. Like there's a big difference. Especially when you compound it year over year. This proves stablecoin adoption doesn't necessarily reduce bank deposits. Economic growth lifts deposits and stablecoins alike. The financial system has room for both traditional banking and innovative digital assets to thrive. And if some money migrated from demand deposits into stablecoins, that might enhance systemic ability. I'm going to stop there for a second and welcome some more people into the stream. What up? What up? They don't want us to compete, is right. What's up, Sanush? What's up, my friend? It's all about greed. The banks are being greedy. They think they're entitled to a monopoly on the financial system. Kind of had that one for a while. They've kind of had it for a while. They kind of had the monopoly for a while, right? All right, bro. Be safe, Joe. I-Man is in the building. What's going on, I-Man? How are you, bro? Mag 5? What's your Mag 5, bro? What's your Mag 5? I-Man says, I have completely moved all of my fiat to the digital asset space. Nice. Nice. They need to keep up or take what happens. Nice. Fiend is in the building. What's up, my guy? How are you? That's right, Shanush saying we do need clarity, but not at the expense of being financially stifled. Indeed. Rick Cisneros is in the building. How are you, my friend? The banks are not only greedy, but sneaky, trying to change the bull at the last minute, right? A lot of people don't understand it. Oh, Mag 5 meaning the banks. Oh, yeah. 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 So, That's right, Sanush. Sunish. Self-custody in DeFi basically equals self-governance, 100%. 100%. That's exactly right. All right, let me finish on. Again, I'm reading an article, just in case you guys checked in here late, from former Congressman Pat Toomey. Former Congressman Pat Toomey. Now, looks like he's on the council over at Coinbase, so there's that. All right, and said, and if some money migrated from demand deposits into stablecoins, that might enhance systemic stability. Traditional banks borrow, this is important. This is important because it's a lot of people's deposits that are being hoodwinked and, in Brian Armstrong's words, gambled. Right? It's important, right? Traditional banks borrow over short time frames and lend over longer ones. A structure that carries risk from runs on deposits, as recent failures remind us. Stablecoin issuers must hold cash and cash equivalents. They take no credit risk, and their assets maturities match their liabilities. Like, if you take a second to think about why you're in this space, it's because deep down inside you know that the system has been rigged against you. Like, you know it, and it can become evident in your bank accounts. It can become evident in financial family arguments or debates, discussions. It can feel evident. I remember uh, being when I was working for the FAA. I remember thinking I was making tons of money, but it didn't feel like it. Right? It felt like 85 a year. Right? It felt like that. Why? If it's 180 something, why does it feel like 85,000? Taxes, inflation, things like that. A system just kind of rigged against you. Right? Now we know what it is now, right? We know what that is now. We got a 12% hurdle rate. And I know that my raises every year as a federal employee were not 12%. And it's been about a 12% hurdle rate for decades. Because you know, unless you're able to take 180 something and live like you're on 75,000. I'm not sure who signed up for that. That maybe it won't feel as hard, right? Stablecoin issuers must hold cash and cash equivalents that they take no credit risk in their assets maturities match their liabilities, eliminating the mismatch that contributes to bank fragility. Runs on fully backed stablecoins are implausible, but if they did occur, they would be manageable as redemption demands could be met immediately with higher liquid assets. It's a better model. I don't know if it's perfect, but it's better than what we got now. We are at the behest and beholden to essentially fractional reserve lending. Why is it in contract and policy when you sign for a banking account that you acknowledge that the money you deposit is no longer yours? Why is that a thing? Why is that a thing? And a lot of people forget about all of the debanking that happened. They just could forget about, oh, oh. Even Brad Garlinghouse himself apparently has forgot about his own personal debanking. Apparently, for no reason. And like, oh, that's just, oh, that's just what the banks do. They just put your finances at harm and just no longer want to give you services because they can. You've done nothing wrong. And people and these YouTubers are just good with it. Oh, okay. If I sign something, is that not a contractual agreement? What's in that contract that said they can get rid of me anytime and I don't have to have performed any negligence, broken the law, called someone a name, nothing. They can just see you later. We're not providing banking services to you. And people are okay with that. A lot of people say, well, I have to have. This is why we're here to get away from that. I have to have some type of account with the banks. This is what this new financial system is about. And it's not just debanking. Debanking is, I say that's like, it's not. I've heard people on the channel tell me that, I remember in the early days, 2017, 18, remember you tried to do some crypto transactions? You remember that? Remember those times you tried to do crypto transactions and they wouldn't let those transactions go through? You were trying to buy some crypto on Coinbase or Binance US or Kraken. You remember? I hope we don't forget that kind of stuff. But we need clarity. We don't need bad clarity. All right. So anyway, runs on fully backed stablecoins are implausible, but if they did occur, they would be manageable as redemption demands could be met immediately with higher liquid assets. Some claim interest-paying stablecoin issuers should be considered banks and subject to bank regulatory requirements. But since stablecoin issuers take no credit risk, make no loans, and have no maturity mismatch between their assets and liabilities, subjecting them to complex prudential banking regulation would make no sense. The reason why the banks have these regulations is because they're practicing gambling and putting depositors at risk. That's why they have the regulations. Don't tell me the regulation is for protecting consumers. It's not. The banks already have the playbook. Hoodwink and bamboozle, and to the tune of billions of dollars. And if we do something wrong, we pay millions of dollars in fines. And so we're up net profit to the tune of billions. And then the depositors, by way of their tax dollars, will bail us out and we won't go to jail. Why do you think all this shorting is going on with silver right now? Because it's just something to do. Why do you think that's going on right now? They already know. We're going to rake in billions. And if we did something we weren't supposed to do, we're going to get fined and we're going to pay millions. And the people will pay the price. That's the system. And people are upset with Brian Armstrong walking away from a banking lobby, essentially written Senate version of the Clarity Act. Why do they call it market structure? So this whole idea of Coinbase is trying to perform banking functions, they're not. The USDC rewards in specific, they're not. They're not taking deposits. They're not offering FDIC insured products. This is not Fidelity Cash Management. They're not doing that. But ask yourself, why don't you ask yourself this question? Well, why did they do that? Why did at the last second of the last hour drop a 270-page addition or rewrite. 270 pages. Who's going to be able to go through that? Why did they do that? You think that's just, oh, they were short-staffed? But since stablecoin issuers take no credit risk, make no loans, and have no maturity mismatch between their assets and liabilities, subjecting them to complex prudential banking regulations would make no sense. But here's the part that most people miss. The banks have a mismatch, and they know it, and they're allowed to get away with it. And if you've been in crypto, you know it. But what has happened to most people on YouTube is they've been hoodwinked and conditioned to say, well, it's FDIC insured. What does that mean? It's underfunded. It's essentially bankrupt. What does FDIC have to do with anything? I'll say it again. It's underfunded and essentially bankrupt. What they are relying on is not everyone coming to get the money at the same time. They know it's underfunded. They know it's nearly bankrupt, and they don't care. Besides that, what if you have more than 250,000? Well, just put it in other banks. All right, so I want you to think about this for a second, because a lot of people say that. Well, just open up other accounts in other banks. So if one bank is risky, right, because there isn't a match, they don't have the amount of money that match the deposit. So your money is at risk. So what you're asking me to do is double my risk. And what you're asking me to do is triple my risk. And what you're asking me to do is quadruple my risk. That's what they're asking. That's what they're saying. Increase your risk. How does that make sense? At best, for someone under 250K, at best, what they do is electronically close your account, electronically open up a new account at another bank, and your money is there electronically until everyone at that bank goes to get their money. The only way your bank is insured is if you exit out of that system. Because if you have your $249,999 in hand, then you have $249,999. If you don't have it in hand, you don't have it because you signed the contract that says that money is not your money. You agree to it. Do you understand? But Senator Pat Toomey explains here in the stablecoin market, they have that. They have no credit risk. They don't make no loans, and they don't have maturity mismatches in that model. That's what the Genius Act did. Which model would you rather have? Okay? So, history offers a lesson. In the 1970s, many banks, fearing what they saw as competition, opposed ATMs. Let me say that again. History offers a lesson. In the 1970s, many banks, fearing what they saw as competition, opposed ATMs. This was their argument. They feared job losses at the banks and the erosion. This is an important one. The erosion of personal banking relationships. Today's resistance to stablecoins echoes that same protectionist impulse. The choice now is to protect incumbent banks or protect America's competitive edge. While China moves aggressively in the digital asset space, Congress should choose innovation over protectionism. Stablecoins are a safer, faster, more efficient way to move dollars. And anybody who says Coinbase's self-interest is acting in its own self-interest, I would argue, is Ripple not acting in their own self-interest? Or are they acting in other people's interests and they don't care about their own self-interest? Why are they here? To put their interests aside and give way to other people's interests? Or is Ripple here for their self-interest? I got some choice words for those folks over at Ripple and the moves that they're making. I'll say that for another video. The choice now is to protect incumbent banks or protect America's competitive edge. While China moves aggressively in the digital asset space, Congress should choose innovation over protectionism. Stablecoins are a safer, faster, more efficient way to move dollars. The marketplace, not regulatory favoritism, should determine which products succeed. Is there bias in this article? Of course. If this dude is on the council at Coinbase, but what he says here is factual. What does it say? He's a member of Coinbase Global Advisory Council. Iman says Brad Garlinghouse has to pander to the banks now. I posted on this on X a few days ago, and I'm paraphrasing, but I essentially said most people think Ripple getting a banking license and whatever the Fed thing that they're doing and all that stuff is good. And I say, good for who? Who is that good for? Probably good for Ripple and the shareholders, but that doesn't necessarily mean that it's good for consumers. The banking model, and I added that in there, not in its current banking model. If Ripple gets this license and has to operate in that banking model, they didn't create it. But in order to participate, what do you think you have to do? You got to bow the knee. But oh, hey, we won't do anything about taking a license away, but we'll throw you over here in this black box, black box over here and throw shade on it if you don't cooperate. Remember? We're not telling you what to do, but hey, we're gonna put you over here in this box here, and there's these stuff that we got to offer to help you. Well, you don't have to offer those to you, but we won't take away your license. You don't think that they don't have to bow the knee? The only way that they don't is if the banking model is changed. And the only way it's going to change is by way of competition. If there are better things out there available for the consumer, for retail, that's the only way. I'm right now, Sanush says, I'm right now earning more on XRP through Flare DeFi than my bank has ever given me in yield. I can't wait to share this little deception thing with you that these bills are just these deception things. And again, since the presenters are in suits, you think it's the presenters who drew up this thing. And the vast majority of it, 75, 85% of it, no, no, no. It's other people. And I'll share who those other people are who are actually writing these bills. This is another article here I want to share with you. I'll go through this pretty quickly. It's titled The Great Bank Robbery of 2023. The nation's biggest banks are netting big profits from rising interest rates while ripping off everyone else. The Great Bank Robbery of 2023 continues. 2023. The country's four largest banks just announced they are making $64 billion from a scheme in which they charge considerably more to loan out money, thanks to higher interest rates, while still paying customers paltry interest on the financial deposits they're using to make these loans. This spread, known as net interest income, has always been one of the key ways that banks make money. They collect deposits, pay some interest to depositors, and then 0 point something percent, and then offer loans at higher interest rates. I haven't seen many loans at less than 5%. When they're paying less than 1%, that's a pretty good deal for the banks. They collect deposits, pay some interest to depositors, and then offer loans at higher interest rates, which helps them both pay for services and generate some profits. However, thanks to the Federal Reserve repeatedly raising their interest rates, the difference between what banks are charging customers for loans and what they are paying depositors has reached historic levels. Now we're seeing the payoff. The country's top four banks, JP Morgan Chase, Bank of America, Citigroup, and Wells Fargo, just announced that they made $64 billion total in net interest income in the quarter. $14% more than they earned during the same time last year. In other words, this spread is generating $175 million per day in revenue. These banks reported $30 billion in profits last quarter overall. In profit, $30 billion in profit. You know what profit it means? All your expenses are met, all of them. $30 billion in profit. And you got to share in none of that. And again, I bring up they're using our deposits as the primary, the biggest mechanism in their business model. Are these outsized profits trickling down to bank customers? Far from it. Instead, thanks in part to higher interest rates, more borrowers are struggling. At the same time, these banks trumpeted sky-high recent profits. They admitted they are writing off a larger share of delinquent loan repayments, writing them off. The four institutions were on pace to report roughly $5.3 billion in charge-offs, or the amount of the loans they wrote off as losses last quarter, according to Bloomberg. The outlet noted that the figure is the highest for the group since the second quarter of 2020, when the world was in the first throes of that pandemic. To learn more about the predatory bank heist, what you can do to avoid it, and what policymakers can to prevent it, read David Sirota's June 12, 2020 report on the matter titled The Great Bank Robbery of 2023. It's in full here below. Interesting. It's really, really good write-up. This is a quote from someone, which is very interesting. It is easier to rob by setting up a bank than by holding up a bank clerk. It is easier to rob by setting up a bank than by holding up a bank clerk. It's a great point. Let me stop the share real quick. I'm going to see if I can find that article or post on X. It's interesting. Let's see, where did I save it? Let's see, was it here? Very interesting, very, very telling. Really, really insulting, but very, very telling. All right, let me check somewhere else here real quick for you guys. Yeah, it is. Here it is right here. Anyway, let's listen to this together. Let's see, share with some sound.
Consultant to the Obama administration to help develop the technical details of the bill.
Who exactly?
Well, let me do this first. Let me read this. It says, Obamacare architect Jonathan Gruber of MIT admits it was intentionally mislabeled the Affordable Care Act. Intentionally mislabeled because it wouldn't have passed had they admitted it was a tax on the people holding the health insurance plans. It also would not have passed had they been transparent that healthy people would be taxed to give money to sick people. And then he goes on to say that the lack of transparency is a huge political advantage. Now, I'm not talking about specifically about Obamacare. I'm talking about their playbook, what they do in politics. The lobby people aren't part of that, right? That's what quote unquote stakeholders are, right? He openly claimed he relied on what he called the stupidity of the average American voter to obscure certain provisions, while he earned over $6 million in consulting fees. This is for context for where we are with this bill, and I'm going to share with you here, okay, this thing here about we can no longer afford to be naive. All right, let me share this. And if we have time, I'll share kind of a little bit of the steps on how this bill goes from, staffers writing a little something to get into the president's desk. Let's take a listen.
Exactly is Gruber? What was his role in crafting Obamacare?
I don't know who he is. He didn't help write our bill.
Most people think he's one of the best outside experts, Mr. Gruber of MIT.
I don't know if you have seen Jonathan Gruber of MIT's analysis. And so...
Jonathan Gruber is one of the most respected economists in the world.
He attended 5 of the 12 meetings at the Obama White House in 2009, including the meeting with the president.
I was a paid consultant to the Obama administration to help develop the technical details of the bill.
$6 million in consulting fees on Obamacare. Who knew you could make so much money working for the government, huh?
And so...
The fact that some advisor who never worked on our staff.
I've stolen ideas from liberally John Gruber.
Obama's a little more relaxed. I think he took a cigarette break halfway through.
Expressed an opinion that I completely disagree with in terms of the voters.
That passed. The American voters are too stupid to understand it. Call it the stupidity of the American voter or whatever. It's a very clever, basic exploitation of the lack of economic understanding of the American voter.
There's no reflection on the actual process that was run.
And the only way we could take it on was first by mislabeling it. And John.
The only way we could take it on was first by mislabeling it. You know, kind of like the Clarity Act that the House presented.
Kerry said, no, we're going to tax your health insurance. We're going to tax those evil insurance companies.
Gruber, who has been our guide on a lot of this.
But we all know it's really a tax on people who hold those insurance plans.
So the rhetoric from the people in the suits at Congress, both parts of Congress, no, we're going to tax those insurance companies. No, we're going to be taxing the insurance company. Do you understand? It's the same game. It's just people in different suits.
I think it's fair to say that there was not a provision in the healthcare law that was not extensively debated.
This bill was written in a tortured way to make sure CBO did not score the mandate as taxes. If CBO scored the mandate as taxes, the bill dies.
Mr. Gruber of MIT, he's got big computer models, he takes the CBO data, and frankly, in some respect, he's helped CBO by giving some information that CBO that otherwise does not have.
You had a law which said healthy people are going to pay in. It made explicit that healthy people pay in and sick people get money. It would not have passed.
Oh. No, I'm just listening to the thing here. Yeah.
And was fully transparent.
Lack of transparency is a huge political advantage. And over time, it's going to apply to more and more health insurance plans.
And so...
How can that make sense?
Oh, my goodness. And people are talking about Coinbase. And they're not looking. They're not looking where the real hoodwink is taking place. They think it's some guy doing something about his own self-interest. Let me see if I can find this particular thing here and what actually happened when a bill was put together. I think this is the one, but I want to make sure. All right, let me find another one. That's pretty good. This is
Gruber, what was his role in crafting Obama?
Let me see if I can't find my other one for you here. Hold on. I think this is a better one. Because this is important to kind of understand this step. Let me see if this is it. No, that's my video. You want to check out that video too. My feed. All right. It's just important, so I want to share this. What's on here? What's going on? All right. Anyway, let me do this. Let me share this with you guys. Peter Summers is in the building. What's going on, bro? All right, let me share this part. All right, let me share this. This is on X here. If you want to go check it out at crypto_CEEJ, you can. We can no longer afford to be naive. A bill isn't good because it's called clarity. The fight is in the definitions, the carve-outs, and markup amendments. That's where lobby powers show up. People keep saying clarity is greater than chaos or better than chaos. It's a cool slogan, but clarity can also be a trap if the language is written to create choke points and winners and losers. Here's the part that most of Crypto X misses. Most bills are not written by Congress in the way that people imagine. Members introduce them, but the text gets shaped by staff, council, regulators, and stakeholder red lines. Who's controlling the regulators in this particular instance? In this particular instance, the banks, right? Who's the stakeholders? Well, one of them is the banking lobby, right? The real battlefield is committee. Before anything hits the full House or Senate floor, it goes into committee with hearings and negotiations. That's where the influencer narrative usually dies. No one's talking about how significantly different this market structure bill is from the Clarity Act. It's massively different. Okay. Then comes the markup. This is why I say Brian Armstrong was right to walk away before we got to this markup. Markup is basically open the doc and start editing. And just like I showed you that video of this Gruber dude, who did the banking lobby people have? Someone just like him. To pull a wool over the eyes of the American people. And the presenters, because they're dressed up in suits, people believe it. The markup is basically open the doc and start editing. Amendments get offered. Definitions get tweaked, like inducement, ancillary assets. Amendments get offered. Definitions get tweaked. Carve-outs get narrowed. And poison pills can slide in quietly. Surely Brad understands this. That's why timing matters. Walking away before markup isn't drama, it's leverage. And it's very smart. After markup, it gets harder to unwind bad language because everyone wants momentum. So the question isn't, do you support the bill? The question that we should be asking, in my opinion, is who is pushing the key definitions? Who's putting the definition of what a broker is? Who's doing that? Who's putting that language together? Who's putting the language together about whether something is a digital commodity or security? Who's putting the KYC and AML language together? It's not your Congress people. Who benefits from the carve-outs? Who is pushing the key definitions? Who gets regulated as the choke point? If you understand this. If you want to stop getting played, track 3 things. Definitions, like the definition of a broker. What is the definition that they have in there? They got control in there. What does that mean? What is an affiliate? Like they have. The banking lobby proposed these words, came up with these words, by the way. Broker, control, affiliate, inducement. Banking lobby came up with these terms. Carve-outs, like who gets exempted? I saw something that said, I was just reading over one of the, I don't know if it's the HR one or if it was the market structure, but it was talking about, it was essentially saying, you know, Bitcoin and Ethereum and XRP, they're kind of really, really good. But everyone else, yeah, not so much. That was my reading behind the words there. Yeah, those 3, we can kind of get those in the digital commodity bucket, but everyone else and future everyone else's, yeah, they're going to be under the SEC's purview. I thought we had moved past that when we got rid of Operation Choke Point and calmed down Senator Elizabeth Warren. I thought we had got past all that. I thought we were at the point, that that Congress and the administration was essentially saying, oh, no, most of these things are commodities and should be the CFTC. Why did the wording change in this market structure bill? Why are they subtly backdooring DeFi? It's not hard. Get the market structure, put it in a PDF form, upload it to Grok or ChatGPT 5.2 thinking and have it analyzed. It's not hard. So, so if you want to stop getting played, track 3 things: definitions, carve-outs, in other words, who gets exempted, markup amendments, what changed and who asked for it. We can't afford to be naive anymore. It's time we stop following the herd and develop our own critical thinking. You know how we used to always say, president's not really doing the stuff. It's other people behind the scenes. He's just up there for a show. Well, I would argue but that perhaps that's the same look for Congress, especially when it comes to these bills and stuff. And if we don't stand up for a new financial system with a level playing field and no accredited investor stuff, no nepotism, with equal access for everyone, if we don't stand up and fight for that, and not be hoodwinked by Coinbase self-interest and look really into this market structure from the Senate's version of what was supposed to be a clarity act. I didn't see any clarity in there. Weren't we expecting when we first heard about this Clarity Act? Weren't you answer for me in the chat here? Were you not expecting to see this asset and this and this asset is in this category? This asset and this asset and this asset is a commodity. This asset, because they had an ICO, is a security. Weren't you expecting some type of thing like that? Do you not think there's a reason why Cardano is scared right now? You think that's just because? You think it's just for no reason, or are they reading the tea leaves? They got a lot of money to pay people to really dissect this thing, current version of this market structure bill. If it was obvious to me that Bitcoin, Ethereum, and XRP are good, and everyone else down that thing. Remember, the blockchain XRPL was second behind Bitcoin. And in this write-up, they wrote the more established chains, the more established blockchains. Let me ask you a question. Where are you getting your 20Xs from? Right? Where are we going to get our 20Xs from? It's a pretty good chance we're not getting them from Bitcoin, Ethereum, and XRP. Pretty good chance of that. Let me see if I can find another thing. There is that interview, by the way. I'm telling you, you should check out that interview from Paul Bearer Network. You should check that thing out. It was really, really good. He interviewed the guy from I Trust Capital. You should check it out. But I encourage you. You can get two versions. You get the HR 3633 version, and then you can get the market structure bill version. You can put it into a PDF. You can upload that PDF. And you can ask for yourself. You can do your homework. You can do your due diligence. Upload those PDFs to ChatGPT or to Grok. Ask some questions. I just started out from someone who loves crypto and and loves DeFi. Are there any current version? Are there any gotchas in this? Just ask. Just do it. Don't rely on some dude on YouTube or some dude on X or some desperate person for clarity because their chain and their asset has gotten a nod. And, oh, by the way, we'll be operating in this banking model. What's going on, B. Johnson? Peterson. If you want to keep offshore prisons, you need unique wording. Yeah. Right? By the way, people just so you know, people are hoping to get to where Coinbase is. So in my view, he was right to walk away when he did. Let me share one more thing that I put up on X, and then we'll be done. Remember, Mr. Gruber said the first thing was to title to mislead in what the bill is called. That's the first thing, to mislead in what you call it. So they came up with the Clarity Act. And again, I didn't see any clarity in that Clarity Act. What I saw was a whole bunch of ambiguity. Let's see here. Let's see. All right, there it is here. I'm going to end with this. I hope it's been value to you. Do me a favor, hit that like button if it has. Hit that like button. And if you understand or you believe that the system, current model, has been rigged against you, and you want to continue to give the robbers more by passing this version of this market structure bill in its current form, type in no more in the chat. No more ripping us off. So this is what Jungle Inc. posted this with Charles. He says crashing out here. There's a few more clips here. You probably should see this whole thing. I haven't watched it, but there's some few more clips here with Charles, and he's actually pointing to a lot of things that I talk about that's in this version of this market structure. He knows what they're trying to do. He knows what they're trying to do. And he also knows, let's keep it a buck, he also knows that there is a select few that is on the other end of this, and that the rest of the people, they're not. They're not. Clarity in this version, clarity is only better than chaos if it's good clarity. Bad clarity is worse. It locks in regulatory capture, it creates choke points, and makes it harder to fix later. I would rather have short-term ambiguity than permanent bad law. That's what it's about. Permanent bad law. Again, just because they call it the Clarity Act doesn't mean there's clarity. And if that dude is willing, Mr. Gruber is willing to publicly state that they were relying on the stupidity of the average American, and it worked, why do you think they're not trying to do that now? The banking lobby is probably the most powerful lobby in the world. You don't think they can find another Gruber? Or two or three? Of course they can. Remember, the Genius Act was already passed and put into law, and the banking lobby found some people to be able to make an argument to bring it again up in Congress. People like Mr. Gruber. That's what it's about. Because the banks don't want to share in that $30 billion per quarter in profit. And they don't want the competition who is willing to share to be legal. They're trying to make it illegal. Do you understand? That is the difference, my friends. So I hope it helped a little bit to get the bigger picture. I-Man said no more. I appreciate that, bro. Right. So that's, I hope you guys get the bigger picture. I appreciate you guys checking in. Do me a favor and hit that like button on the way out if you get a chance to do so on the way in. We can no longer afford to be naive. Remember, the digital asset space is our chance to win here, guys. We can't just take it for granted. Be careful in who you put on a pedestal and idol just because he looks good in a suit and has a nice beard. Be careful. Be careful. One thing you can do to be more proactive, thank you, I-Man, I appreciate that, is that reminds me, how many of you have signed up with Stand with Crypto? How many people emailed your congressperson about the fact that you don't want the banks trying to take away the ability of issuers to offer 3, 4, 5% on their stable coins? How many of you done that? And go here to, you can just Google Coinbase Stand with Crypto. You can Google that. Google Coinbase Stand with Crypto, and it'll take you here, and you can open the app. And you can log in if you're already signed up, or you can sign up. Right? You can click join the fight, and you can continue here with one of these things, or you can connect a wallet. And I think the wallet was MetaMask and some other ones. Yep. Sign up. And then it's going to get you to create a little 2 or 3 profile, maybe name and 1 or 2 other things. And then it's going to have, once you do your zip code, it'll kind of tell you your representatives. And the thing that they're doing now is asking people to the right to Congress by way of emails already set up. You don't have to, you click a couple of buttons, and it's going to say that you want to be able to get these rewards on these stable coins. So last I checked, so it says, what is this saying? 3 million total advocates, 2.7 million of that is the U.S., but only 250,000 actually emailed the constituents. And Paul Gruel in his, so it's standwithcrypto.org, standwithcrypto.org. Paul Gruel said that even that 250,000 was significant, and that a lot of the people for Congress and their staffers were coming to him saying that they're getting, they're getting the word, they're getting the message that how important this is to them. So continue to take action. Email your senators to pass crypto legislation right here. You just click take action. And never let anyone tell you that your voice, your email, your phone call doesn't make a difference, because it does make a difference. The other thing that I would do is look at the DeFi education fund.org right here. Did I stop the share? This is a massive one. Let me share. Right, DeFi education fund.org. And you can donate here as well. This is the thing that Jake Travinsky is on the board. And you can donate in crypto or cash. We're keeping this funded, in my opinion. It's a big, big deal. DeFi is our solution. DeFi, in my opinion, is our solution, because it's decentralized finance without the middlemen. without this accredited investor and rules. And right now, in that market structure bill, they're trying to really put a lock on the front end of DeFi apps. That's what they're really trying to do. So in the end, all it really is just an interface, but everything else is bank regulation modeled. Who controls the bank regulation model rails? Right? It's the banks. So those are the two places that you can, you can do something. You can get into action. That would be awesome if you guys could do that. So yeah. So I just wanted to share that with you guys. I appreciate you hanging out. It's been a really, really cool hang. Do me a favor again, hit that like button on the way out if you really enjoyed it. And chat in the replay, just know more. If you understand now, hopefully you understand a little bit more of the game that's being played here. And you just got to ask yourself, are they talking about me when they say I'm relying on the stupidity of the average American voter? Do you still think that practice is going on? Do you still think the banking lobbies and stakeholders in this particular bill are doing that? Are hiring consultants and changing the wording? If you don't believe that, I highly recommend you read the book, Propaganda. Industries are turned and shaped from things like this. It's important. It's really, really important. Okay. So again, do me a favor and hit that like button on the way out. If you didn't get a chance to do so on the way in, that would be super duper dope if you could do that. And if you happen to be in that 55% or so of people that are hanging out, listening to and watching the Crypto Seeds, do me a favor. If you've been enjoying those hangouts, please consider subscribing to the channel. And don't forget to ring that notification bell, baby, so that you know whenever we go live or whenever we upload a video. I'm going to end this one like I do all my videos and remind you guys of this. Old money doesn't want you to win. But that's okay, though, because you and I, we're already winning. And I would ask you to consider this or perhaps ponder the idea or notion of living your life permissionless. I'll talk to you guys soon. See ya.